Jyotivardhan Jaipuria is joining us right now, a market veteran, needs no introduction. Jyoti, thanks very much. Good morning. Good to have you with us here. Thanks very much. How would you, first of all, characterize this pullback in the markets that we're seeing? And it's been a sort of concerted overall move in beaten down emerging market assets we've seen, both forex and stocks. Do you consider this to be a counter trend, or do you consider this to be a reversal?
See, part of it I just treat it as part of the consolidation process. So we had like a big move down in the markets globally. There was worry about China, Fed, etc. And slowly what we saw was market had priced a lot of that in. We got some news that, okay, now Fed is probably not hiking as quickly as people thought. In fact, now if we see, it's only in March that people think there's a 50% chance of hiking. All months before that is less than a 50% chance. China the problems are not gone away, but they're not aggravating now. At the moment, a lot of the bad news is there, and from now on, it's seeming like, okay, no more bad news is coming. So I think we got that typical pullback in the market, like India's up 8-9% from its lows. Most global markets are up. And now I think we'll get into a consolidation phase that we've seen these bounce back up, and probably for the next few weeks, we are going to consolidate around these levels.
Okay. Again, so you're not saying this is a reversal in trend. I mean, essentially the market goes back to where it was 6 months back, 8 months back, and go on to make newer highs and things like that. I'm talking about global equities. You don't think that is a possibility at all, right?
Yeah, I think that's going to be a very slow process, because ultimately growth is still missing, and that's the thing which worries me, that if you have a Fed hike, but that is because there's very visible signs of growth. I think that is actually more positive than no Fed hike, but no growth really coming through.
It's confusing to say the least, right? I mean, in terms of this growth, no growth, policy reaction, and also what does the market really want? Does it want growth, or does it want unconventional policy measures to continue? At some level, it makes you wonder, Jyoti.
Yeah, so in the end, I think market will want growth.
Okay.
So at the moment, the first move when, the Fed hike comes, people may say, oh God, this is bad, and we'll have money going out of equities. But if the Fed has got it right, and, the growth actually comes, then, that Fed hike does not matter.
By the way, do you think this Fed hike will happen at all now? This year, even next year?
Yeah, so, at the moment, like if you think of all the people who give their views and all the economists, the earliest, there's at least a 50% chance of Fed hike is in March. So up to March, nobody's really expecting a Fed hike to come. Even though if you see all the Fed voting members, people have been giving conflicting signals. And some of them still say that we need a hike this year. And a lot of others say, okay, now, the growth is slow enough. You're getting data points also which are showing that at least in terms of joblessness and unemployment, the US has reached a stage where the Fed hike is required. But because there's no inflation, I think there just seems to be no hurry from a Fed point of view to really go and hike. Just this whole global deflation, I think, is helping Fed keep interest rates at zero for longer.
Some, like Christopher Wood from CLSA, have maintained for a while now that the next move will not be a hike, it will be another round of QE. You think that is a possibility?
Yeah, so that, assumes that this growth is not coming back. So that is not going to be really very, very positive. It's going to be a bit negative, that in spite of all this QE which we have done, there's no sign of growth. And so you're trying to do one more of the same to engineer growth. It may, take assets up a bit, but ultimately you can't really make money if you don't really get growth coming back.
No, but I mean, if the market, if the Nifty, if the situation remains the same, we get another round of QE, the Nifty goes to 15,000. I mean, that will allow people to make money. Now, at the end of it, what it will do to the real economy and, I mean, the other aspects of the social aspects of it, at least in the US, for example, and things like that, that's a different matter, right? It's extremely political as well.
Yeah, see, the problem is it's not that easy to say, okay, I get one more liquidity burst and the market will keep moving up. Because, there becomes valuations which ultimately do play an important role, and there is like people want growth. You don't get both of those coming, it's not very easy. Like, if you see all this while where a lot of money has got pumped in, markets did not really do too much. They did not give a return which was very spectacular in spite of all the money which came in. Because ultimately that growth never came, and so people said, okay, I won't pay beyond a point for this because the valuations are too expensive.
Okay, fair enough. Uh, so that's you're saying it's still unclear as to in terms of what will happen on the Fed action, but you're saying 50% at least right now. Market participants expecting the first move, a hike only in March of next year.
Yeah.
So that's where we are. Let's come to India now. Is there anything local which is driving the market here, or it has been global for a while and it will continue to be global?
So, there are two things. One is the global trend, which, always makes a difference to where the market is going, and it is one juxtaposition. If you have to play against the global trend, then there has to be either something very positive or very negative locally, which has to become a more important factor than the global trend. So, like, when we got a rate cut which came in India, markets had reacted to that very positively, whether, at that time global factors were reacting or not.
Yes.
If earnings had been very strong, then markets would have reacted to strong earnings. The thing is, we're getting into earnings season where, earnings are probably going to be weak. All the results which have come so far have been, at best in line or slightly disappointing. So to that extent, the tendency of the market will be probably to go down a bit unless you have such strong global factors that it prevent it from going down. So there are local factors which are important and there are global factors which are important. It is, which one plays a bigger role.
But right now, there aren't any overarching positives or negatives locally speaking, right?
It's the earnings. So probably, earnings season is there. So every day you'll get a set of earnings coming.
That is more idiosyncratic in a way, right? I mean, so you could, very large surprise or a disappointment can cause a bit of a blip in the overall trend. And the trend right now is from the global, but it won't change things materially, in a way. Right?
Yeah, so unless, the good thing or the bad thing is that we've got into this results season expecting a very weak set of results. So to that extent, when the results are not going to be very strong, but in line with generally what most people are expecting. I think, the general consensus is we'll end this quarter with a Sensex EPS growth of close to 0. So we'll get earnings downgraded. So what that means is probably the tendency of the market is to be flat to slightly down. And, that is something which will play out unless we have something spectacular happening in the world either way. Otherwise, probably, by the time we end the results season, will be slightly lower than where we are today on the markets.
Yeah. By the way, I mean, if you look at the numbers, right, Infi Q2 was flawless, but the overall number picture wasn't. The guidance cut didn't go down well. TCS disappointed. Lever disappointed. I'm just looking at the big ones, not the smaller ones.
Yeah.
Z was a big surprise, positive surprise. And Indocin, which came out, was absolutely in line. That's the large results. I don't know if I'm missing any, but I think I've covered most. So more disappointments. But as you said, that was expected in a way, right? The earnings were expected to be poor. And that's exactly what one has got so far. Just to look forward a little bit, you got the Bihar elections, right? Today is the second phase of polling there. Do you expect that to be material in any way?
See, it will add to one of those, like if you just do a pure, simple analysis of past assembly elections, and has it really made a difference to the market? Has it changed the market trend? The answer is no. No assembly election has really changed the market trend. It, around the time of the election results, it would be one factor which people will be watching that, okay, is this a signal that we are seeing, the Modi government in a different light? Are people still happy and enamored with the Modi government or not? But ultimately, a lot of assembly elections are local elections. They are a play of local factors, local alignments, local regional tie-ups. And to that extent, I think it's not going to be a very material factor. Though, probably in November, it would be something to keep a watch on.
Okay. So whatever the trend is, it won't change that, a bit of a blip, maybe a big one for a while, but it won't change the trend.
That's right.
At that point. Do you think that by the end of the year will be meaningfully different from here at an index level, aggregate index level, Jyoti?
So my would be, I think we'll be slightly higher than these levels by the end of the year. Though before that, we are probably going to go slightly lower, maybe 4-5% lower. So from that point, we'll probably end up having a bit of a rally. And there's no real reason, like we see it at the end of most years, where you have the year-end effect which plays out. results would have got out of the way, and hopefully we would have a parliament session where some noise on reforms would have taken place. We have moved one step forward to GST, hopefully.
Are you bullish though, from a 1 to 2 year perspective? Do you think there is meaningful money to be made in absolute sense?
Yeah,
in
I'm
Indian stock
quite
market?
bullish on the market. I think, see, what we are seeing is very slow signs that the economy is bottoming and starting to recover a bit. And I think, slowly this will keep picking up. At some point, and that point maybe 6 months away or 9 months away, we'll get earnings which will start looking substantially better. We'll get those, 15% sort of earnings growth, 20% sort of earnings growth coming through. Maybe that's not like, in this quarter, the next quarter, but somewhere in the middle of next year, you get like suddenly earnings expectations is a 15% growth, and that is beaten, and you end up with 17. And, you'll have markets then really starting to do well, because markets will start pricing that turnaround has happened in the economy.
And what will drive it, or it'll just happen? I mean, how do
So yeah, it will be driven by two things. Basically, one is, a slow turn in the economy. And the turn is happening because government has got a little more leeway to spend. They're spending more. Second is you'll have the pay commission next year. And if you go back into the history of pay commissions, typically in the year in which the money comes, you get one of those blips in consumption which happens. And then you have like a combination of a couple of these things. Interest rates have come down, so that will start making an impact on growth. Top line starts to pick up. And once top line picks up, the operating leverage is normally very huge in the first round of the cycle, because you also get a stocking effect, and you get this capacity is already there. So, people are they've covered their fixed costs. So every increase in top line starts flowing to the bottom line.
Okay. I just want to come to specifics. So just taking lever results as an example, pricing is degrowing, volume growth is 6%, 6.5%.
Yeah.
And that is expected to be the case for most consumer staple companies for a while. What happens to sort of valuations when we get this kind of a scenario persisting for a while, say the next 1-2 years, if we get this kind of situation?
Yes, my view is like the rural consumer was doing very well over the last 5-6 years. The next few years is not going to be as good for the rural consumer. And so that's going to reflect in most people who are like supplying to the rural consumer. So people with rural markets are going to struggle a bit in terms of their top line and in terms of their sales growth. Like if you think of consumer staples particularly, I'm not very excited about it. I think these stocks are quite expensive, especially given that margins are at like a peak for them. Stock price has been very strong. And probably what you're going to see is we are running at peak margins and peak multiples for these people. So I don't think these are going to do well over the next few years.
Can't the same thing be said about discretionaries like autos, etc. as well?
So discretionaries, they are not running at peak margins. They are running at margins which are higher than what they used to be a couple of years back. But, that top line has been way below trend for the last few years. Like even now, if you think, it's only the last few months that we've seen auto sales pick up. Otherwise, you were running at, close to 0% auto sales growth, which is way below trend. So that has to change. In fact, for them, the near-term trigger is the pay commission, which will come through. For everyone as a whole, like when you look at a deflationary environment, sometimes the top line tends to mislead you because all product prices have fallen. So like steel has fallen, so end product prices have fallen. So even with the top line, which is not as strong, you could have like EBITDA margins which are good and EBITDA growth which is good, because everything's just come down. But so for like autos, what will happen is you have steel prices which have come down. Plus you have a top line which hopefully will start picking up. So you should get that double whammy coming through.
When I think about what is the market really, consensus really bullish on, I can narrow it down to 4 things. One is financials, private banks and NBFCs. Second is consumer discretionaries. Third is IT. Fourth is pharma. That's it. Do you agree with this list? I mean, this is where majority of the money will be made.
I think normally when everybody is very excited about something, money probably is made there, but that's not where the biggest money is made.
That's what I was coming to.
Yeah.
So if everybody is bullish, then I mean.
So like if you look at the next 3 years, maybe the biggest money is not made in some of these sectors. It's made in something like industrials. It's made in cement.
Something else, because this is in a way index hugging, right? I mean.
So it's,
just staying close to what has been doing well.
It's, I always look at this over-owned and under-owned, because for me it's like under-owned, undervalued and underperforming stuff is something which, probably can be the big winner over the next few years. And so today what nobody wants to own is any of the industrials for a reason. So my view is some of the industrials which are not probably infrastructure, but which are more, they are ENC players, they probably will do well over the next few years. They may not do well this quarter, but next 3 years, that's probably one of the places where you'll make money, which nobody is really looking at today. And, probably cement is just a corollary of this, that, it's easier to find big and better companies in the cement space. They'll do well once we have some of this pickup happening, especially stuff like roads are picking up a lot, which is very cement intensive. Housing will pick up. So some of these things will start helping you, and cement demand will pick up. Capacities are not coming up in a big way. So you'll get this super cycle coming up in cement for a couple of years.
By the way, cement is another area which everybody likes, but hasn't performed.
It's not performed, and neither the company's earnings performing, nor are the stocks performing.
I want your thoughts on what is coming up right now at the bottom of the screen right now. Let's just put the graphics up. So this is the entire call drop issue, and TRAI is saying that is now putting sort of some exacts here. Telcos will pay 1 rupee for each call drop. The number of call drops in a day for which users will be compensated, I think, are 3. So this is TRAI recommending. I guess the Department of Telecommunications has got to now weigh in and say whether this is going to be implemented or no. I would reckon majority of the people would say, well, this won't be implemented. But anyway, 1 rupee for each call drop by operator. And companies to compensate from the 1st of January 2016. Any thoughts, Jyoti?
See, it's an issue which I guess, the government has been very focused on. Means I don't know exactly. We'll have to look at the whole details of this, because, the companies, the telecom operators will obviously be hesitant to, because somewhere they'll have to start defining what is a call drop first of all, and then what is a fair compensation to be paid for the call drop. So I don't know. I don't want to comment on this till I've looked at some of the more details coming through.
Yeah. I think I tend to make 3 rupees every day. But anyway, I mean, on a lighter note, I just since I've got you, I just want your thoughts on what happened with DCB recently. What did you make of the change in strategy, Jyoti, which happened? Said, well, we're going to expand, double the branch network in double or 300 new branches, right, in the next 12 months. Now this morning they're saying, well, we won't do it over the next 1 year, we'll do it over the next 2 years. What does it tell you?
Yeah, see, in general, it's like, there's this balance between near-term profits and quick growth. So every time you try to grow very fast, you probably take a hit near-term on your earnings. And then that starts to weigh that, how much hit do I want to take on the earnings? And how much do I want to just take this bet that I'm growing fast, it doesn't matter what my current earnings are. And a lot of companies try to find that balance at some point, when near-term things start to get painful, though, you have a strategy, people tend to modulate their strategy and say, okay, let's, slow down the pace of that growth. Let's not grow at that same pace, because what if this does not work, or what if the economy does not pick up pace at the same rate at which we think it is going to pick up pace for our strategy. So that, tends to be like one of the issues with a lot of companies, and they tend to face it. Because once you get a listed company, you have a lot more pressure from not just from outside shareholders, from media. You become a bit more visible.
No, but the point is that there are a lot of new banks which are coming in, right? Payment banks and all. Basically, some 20 odd licenses have been issued now in the last 1.5 years. All of them are going to go after liabilities in a big way. So the raise there toughens, and DCB in its wisdom well thought we should expand aggressively. Otherwise, how are we going to get deposits?
Yeah.
Right? So maybe they were ready. It was a well thought out strategy. Said, well, this has got to be done, and we're ready to do it. And now, because of the pushback from the market, they are saying, well, we won't do it over the next 1 year, next 2 years. I'm just asking you, which of the decisions was correct? Do you think the first one was correct, or this is correct?
See, the thing is, longer term you have to grow faster, then you have to, capture market share, which is like a right decision. At the same time, for every company, it is the pace at which you do. Because, there are lots of things. It's like any manufacturing company can go and put up 10 times the capacity they're putting up. But they'll start struggling if things don't go right in the next 6-9 months.
Yeah.
So, they may be right over the next 10 years. They may not exist. So it's the same thing for, any of these banks. They have to decide which way to modulate. And though, a lot of private players will come up, what we have to remember is that the public sector banks still have a very, very large share of the market. And so secularly, what you can see is the public sector will keep losing share to the private sector, partly just to the existing private sector guys, and secondly to the new people who will come in. So it's not like just because 20 new banks come in, you'll not, be able to raise deposits because, there'll be like a surplus of banks. Because for most people, it will be, I have to get my share from the public sector banks.
Okay.
And I have to provide better service, better technology, and that will get it for me.
Okay, got that. We'll leave it there, Jyoti. Thanks
a lot.
very much
Yeah.
for your time. It's always great speaking with you.
Bye.
Thank you.